Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. And here we are on a Thursday. Let's pretend it's Friday.
Bob, we'll start off the show with a couple of questions from our faithful listener, Chris. From Chris, the first question is, will the unprecedented U.S. infrastructure bill delay U.S. state and local governments' day of fiscal reckoning by significantly removing the financial burden of school, airport, water, road infrastructure obligations? And could this be the time to actually buy municipal stocks or bonds relative to most everything else?
Well, the first part of the question is infrastructure, stuff like that. No. Oh, no, that's fiscal policy, and who knows what'll happen. You can have all kinds of proposals when it comes to fiscal policy, and as what gets carried out in what manner is another one. So that, Chris, you got a good conjectural question there. And then could it be time to actually buy munis? Well, this was very timely. It was a couple of days ago, and the munis have popped as there was an announcement that with the Fed buying, they would probably buy junk bonds as well. And munis, of course, rate much higher than junk. So there's been a tremendous relief rally. So, but for long-term hold, for investors, I'm doubtful of the munis because in a slowing global economy, the U.S. economy is taking a whack. So is Canada. But we're within a slowing economy, and the problem will be servicing debt. There's just not enough cash flow out of the economy to service the debt mania. And this has been the problem with every great financial bubble. While the stock market gets most of the attention, underneath it is the equivalent speculation in the bond market. And when the prices go down for everything, because you have an everything bubble and then everything collapses, then you get into serious problems in servicing bonds. So, trader, yeah, but a long-term investor in munis, don't think so.
Chris's other question for us. Bob, I've read that the Fed is effectively backstopping everything except stocks and high-yield junk bonds. Are we headed towards the nationalization of the financial markets and thus suffer a 25 to 30-year market malaise like Japan? Thanks for sharing with us each week, says Chris.
Maybe, Chris, maybe 25 years of market malaise, that might be the best side, the best possibility. Just a chuckle on that one, but I know that it's not been widely published, but during the 1929 crash, movers, policymakers and central bankers then knew that a financial contraction would be followed by a recession. And this is where they had the Federal Reserve set up as the lender of last resort, and it would fix everything. And in the October, November, during the crash of 29, the head of the Fed, New York Fed, of course, the big chapter within the chapters of Feds, it was New York, and a guy by the name of Harrison headed it up, and he bought bonds out of the market, and he exceeded his limits by a factor of, I think, 6 times. So the truth of the matter is the Fed was very accommodative during the crash, and then you go as far as into July of 1932, which was actually the bottom, and Barron's in an editorial wrote that every anti-deflationary measure taken by the Fed, such as buying bonds out of the market, is seen not to be working. So it was a bit of a despair, and that was actually the low for that first move down, the first bear market, July 1932, and it was also a bear market for low-grade bonds. So, and then I remember looking at Barron's and making notes week by week in 1932, and in that 2-week period, say in the bottoming part, there was no news. But what happened is the relentless offering of bonds stopped, and suddenly, then the market turned around and rallied. So the past is very helpful in understanding the way financial markets work, but it's not exactly a crystal clear path. And so here, of course, the intrusion in the market will be extraordinary. But hey, they intruded extraordinarily in 1929 as well. So my guess is that, well, we thought on April 2nd, we put out one, Get Constructive was sort of the title, and we're looking for the decline to have a test and then rally. So this rally could maybe make it through until May or June or something like that. And then you got to face seasonality. So, this is going to be extremely difficult times. And if you're a very good trader, it's wonderful. But if you're not, I wouldn't try and trade, and I'd just stay defensive in the investment side.
We'll have more with Bob Hoye right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, a U.S. IPO of a Chinese company went bust after 11 months. What's the story there?
Well, that was the story. That was the headline. And, of course, it wasn't so long ago that you had the new issue market, and everybody had to buy the hot new issue stocks, and as they call them, IPOs. And then they didn't show a chart with that one, but anyways, it's in. And there's always the last issue in a new issue market, the one that fails. And gosh, I remember that one in the 1968 new issue market. It was absolutely incredible. And at a future date, I'll tell that story because it'll take a bit of time.
Well, Bob, should people be wary to put an IPO in when it looks like the markets are about to peak? They're going to come down.
Oh, yeah, but, the passions of the day, and you've got to be with the play. I'll tell the story. It was
tell the story.
Hot new issue, and so we were allotting, I was working for a really good regional brokerage firm in Vancouver the firm was doing a lot of new issues, and they were coming out and doubling or tripling. And so what you'd do was, I was on the institutional desk, and you'd allocate small amounts of the new issue stock to, say, a fund, and they would put the fund, that position into their dividend fund. So it would go in, and then they'd sell it. So then they captured some revenue for it because the allotments were so small you couldn't put it in an ordinary investment portfolio. And then, of course, there was the retail side, and they were all hot to get each new issue. So on each one, they would say if they could afford 200 shares of it, they'd put an order in for 500 and know they'd get cut back to 50. So then they'd put orders in at the trust companies around town, and pretty soon we got to know this guy's footprint, and then each time when he only got small amounts, he would be nasty with his broker and rant and rave and shout and stuff like that. And then finally came the one that we knew you could sense the market changing. So he got filled all over town. He might have bought 5 times what he actually wanted, and it went against him very badly, and there was a whole lot of problems unwinding it. And then, of course, he was ranting and raving about that we did him wrong. So that's what a new issue market is like, and I'm sure that the equivalent has been happening this headline, at least it shows there was one view all of a sudden, and it's down in price. So it's a fascinating study, new issue markets, or as they call them in the U.S., initial public offerings, or IPOs. I still hate that phrase.
We'll have more with Bob Hoye right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, looking at some of the headlines of the day, department stores most likely to default on debt. Why would that be?
Oh, yeah. Both department stores and also they call them big box stores in the malls have suffered because of the change from people going shopping at malls to Amazon and shopping online and having it delivered to your home. Now, mind you, even from decades ago, the big department stores had delivery services. I remember one years ago being down in Vancouver, downtown, and a guy owned a building there that had been the stables for the horses and wagons for the Hudson's Bay or Eaton's department store for deliveries in the downtown area. So, but in this case, you've had this enormous transition from buying retail at a store and then buying it internet. And you've had huge changes before because you had, I guess, around 1900 when you had Sears Roebuck start with catalog sales. And hitherto, you had retail outlets in small towns and at crossroads in the country and everywhere else. Then all of a sudden you had these catalogs with Dreamworld stuff in it, and people would order from there and have it delivered via the postal people. So in retail and in actually free markets, the feature is change, and it was Schumpeter who said, called it creative destruction, where when the market doesn't want anything anymore, it gets to go broke and fail. And when the market wants something, the guys who are providing it get to make money. And it's a wonderful way of it's information. A free market provides information. And if people want to buy something, the price goes up, and then that tells the suppliers to get more into the shelves. So, except recently with this panic buying with the Wuhan flu, That's extraordinary, a most unusual circumstance. But these, of course, with this break, and oh my God, it's been a hell of a hit. Hopefully it restores itself somewhat. But, yeah, there's going to be more headlines like that. And then also, speaking of headlines, the ones that we haven't seen are announcements of important defaults or insolvencies. The changes in the markets have been so huge that there's bound to be some big banks or people or trading desks offside on this, and maybe the losses are yet to be reported. So, then the other one, and I'd forgotten to use this, is an old one. When the market breaks, the broker used to say, here it is, the next thing you hear will be the sound of dividends being cut. And we're seeing that. There were, I didn't grab that headlines, but I've seen them floating around, so we'll have to make a note on those.
Another headline that caught your interest was the year's hottest cars are now cold as ice.
Yeah, they were all the hot, flashy cars we're buying and them things. And in the 1720 South Sea bubble, nouveau riche, people who went from virtually nothing to making a huge amount of money. And some of the flashiest went out and bought a coach, team of 4 horses with liveried footmen and the whole thing. And then come the crash in the fall of 1720, all of a sudden there was an area in London, open fields, where people would go to sell second-hand horses and second-hand coaches and stuff like that. So all of a sudden there you were with a number of fine coaches for sale, and this grabbed this headline because it was about hot cars getting cold as ice. But also remember in the dot-com bubble of 2000, and that harsh break, all of a sudden there were a number of Porsches and Ferraris, leases that were being broken, and cars for sale second-hand at deep discounts and stuff like that. So there's nothing new ever in the financial world.
Bob, should companies have bought back their shares so their CEO could get a big bonus, should they be allowed to be bailed out this time around?
No, because the one is like the airlines. Apparently they spent something like $45 billion buying back their stock, and now they want a $45 billion bailout. And no, there's been all kinds of operations going on in the stock markets for centuries. And I looked this one up just a little while ago, and the buybacks were allowed in 1982. And the timing on that was that you had the stock market reach in deflated terms, like deflated by the CPI. It reached its real high in 66 or 68 on the, I think in 66. But anyways, you went into a bear market in real terms for the New York Stock Exchange right down to the middle of 1982. So of course what it was is the bureaucracy related to the stock exchange saying, oh, it's been that bad for so long, it'll help out if we can allow stock buybacks. But of course, it goes on the books at the bottom of a market, and then it ends up being abused at the top of the market. And the one I feel most strongly about was Boeing's, which, hey, it's a long-time Seattle company. I never traded the stock, but I always admired the company. And so here they are in a long period of flat earnings growth or dull earnings growth, and they spent billions buying their stock back. And also then they became super thrifty on modifying the 737, and it should have had a whole new rebuild because the new, more efficient engines have such a large diameter that then they had to mount them on special pylons, and it changed the balance of forces with that aircraft. And so then they tried to offset it with their computer programs, and then they were using discount computer people outside of the U.S. to do that, and it was maybe, I don't know whether they spent $10 billion on buybacks, but and then then you had the disaster of the 737 MAX. So this one will go down in market history as a very serious tragedy, and it's not over yet. But then the bailouts, who knows what's going to happen there, but we're just going to stay with, we've got a model that worked getting us to the top in January and the break. And on January 3rd, I think it was, I wrote that, we had all the stuff in for a top, dynamic excesses, at the right time. And then you can never know the story that'll go with the decline. And of course, the decline came in, and it coincidental with the Wuhan virus panic, and you had one of the sharpest sell-offs in history. But the main thing is the media would come up with the reason why it went down, and the reason was this health panic. But I think that this rebound now could go into the middle of the year, and then we would look for seasonal problems later in the year. There's no way, I think, that a bunch of magic with throwing credit from nowhere into a credit contraction and thinking it's going to go away is rather naive, but that thinking has been around since the crash in 1618, and it sparked an intellectual to come up with a remedy for the hardship that was with that crash. And of course, what was the remedy? Oh, there must be credit we can get from somewhere to prevent the credit contraction. And this, of course, is what Keynes came up with independently in the early 1930s, and then you had it repeated by Paul Samuelson in the 1960s, and more recently Paul not Kudlow. Anyways, you'll know the guy I'm talking about. Anyways, there's always somebody who says in hard times, money from somewhere will make the problems go away, and I think this is one more chance to show that it doesn't work.
Won't this be the 19th recession since the Fed was invented?
Yep, Jim, that was a good one to bring up because there were practical people, policymakers around in the early 1900s, and they came up with a very appealing theory that, recessions follow a credit crisis. So then they had the Fed as the lender of last resort, and it would come in and prevent a problem that would initiate a crisis, and that would then prevent recessions. And, the number has been 18 recessions since 1913 when the Fed was formed. Actually, they didn't open their doors for business until January 1914. And it's the National Bureau of Economic Research that determines the business cycle. And here's the irony. Quite likely a U.S. recession has started, but it will take probably a year before the NBER comes out and says, the recession started in January or February. It's the way they work. It takes them a long time to really decide that there is a recession, and then we'll just watch and see with that. But highly likely that there is a global recession, and the policymakers have their theories that throwing credit at a credit contraction will make it go away. That theory's been around since 1622. So I'm a skeptic on it, Jim, and we'll just watch and see how it follows. But what we will be doing, of course, advising our subscribers on when it's oversold and time to take a position, and when it's overbought, time to raise cash, which we've been doing for quite a few years.
Wasn't Einstein's definition of insanity doing the same thing over and over again, expecting different results?
Oh, yeah, Jim, that's such a good one, and that's really describes central banking to a T. So.
And it must be true because it's on my coffee mug.
You're lucky to have a coffee mug with that on it. So,
thank you so much, Bob, for being on the show.
Good to be with you, Jim, and look forward to next week.
If you're like our listener, Chris, you can ask questions of Bob. All you have to do is send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.